Why invest in the stock market? First, let's answer the big question. Why should you even invest in the stock market? Imagine your money as a seed. If you leave it in a savings account, it might grow a little, but not much, because interest rates are often very low. But if you plant that seed in the stock market, where companies grow, expand, and make profits, your money has the potential to grow much faster. The stock market has historically given an average return of around 7 to 10% per year over the long term. That means your money could double every 7 to 10 years. Compare that to leaving it in a savings account, where inflation slowly eats away at its value, and the choice is clear. Understanding what stocks are. Now, what exactly are stocks? Think of the stock as a small piece of ownership in a company. When you buy a stock, you become a shareholder, which means you own a fraction of that business. If the company does well, the value of your stock can increase. Some companies also pay out a portion of their profits to shareholders in the form of dividends. So investing in stocks is basically putting your money into companies that you believe will grow in the future. Getting started. The basics. Okay, so how do you start investing? Here are the steps. Step 1. Open a brokerage account. A brokerage account is like the gateway to the stock market. It's similar to a bank account, but instead of holding money, it lets you buy and sell investments. There are many online platforms available today, such as Robinhood, Fidelity, Charles Schwab, or even apps like eToro. Most of them are easy to set up and can be done in just a few minutes. Step 2. Set your budget. Investing doesn't require thousands of dollars. In fact, you can start with as little as $10 or $50, thanks to something called fractional shares, which allow you to buy part of a stock instead of the whole thing. The key is consistency. Even small, regular investments can add up to big wealth over time. Step 3. Learn the different types of investments. Individual stocks. Buying shares of a single company, like Apple or Tesla. ETFs, exchange-traded funds. These are bundles of stocks grouped together, often tracking an index like the S&P 500. They're a great choice for beginners because they give you instant diversification. Mutual funds, similar to ETFs, but they're actively managed by professionals. Bonds, safer investments where you lend money to governments or corporations in exchange for interest. For beginners, ETFs are usually the safest and easiest way to start. Important strategies for beginners. Now that you know how to start, let's talk about strategies. 1. Think long-term. The stock market can be volatile in the short term. Prices go up and down daily. But over years and decades, the market tends to go up. So avoid panicking during dips and focus on the bigger picture. 2. Diversify your investments. Don't put all your eggs in one basket. Instead of betting all your money on one company, spread it across different industries or use ETFs to invest in many companies at once. This reduces your risk. Free. Invest consistently. One of the best methods is called dollar cost averaging. This means investing a fixed amount of money regularly, say $100 each month, regardless of whether prices are high or low. Over time, this helps smooth out the ups and downs of the market. 4. Avoid emotional decisions. It's easy to get carried away by hype or fear. When stocks rise quickly, beginners want to buy. When stocks fall, they want to sell. But the truth is, emotions are the enemy of smart investing. Stick to your plan. Common mistakes beginners make. Here are some mistakes to avoid. Trying to time the market. Nobody can perfectly predict when stocks will rise or fall. Trying to buy at the bottom and sell at the top usually fails. Investing in companies you don't understand. Always research before you invest. Don't just follow the crowd. Ignoring fees. Some platforms or funds charge high fees, which eat into your returns. Always check the costs. Not having an emergency fund. Never invest money you might need soon. Always have a safety net in savings first. If you're nervous about getting started, that's completely normal. The best way to learn is to start small. Even investing $50 or $100 can help you understand how the market works. Over time, as you see your investments grow, your confidence will grow too. Also, keep learning. Read beginner-friendly finance books, watch educational videos, and follow trusted sources. The more knowledge you gain, the better your decisions will become. Remember, the most powerful tool you have is time. The earlier you start investing, the more your money can grow. So, don't wait for the perfect moment. Start today. Even small steps can lead to big financial growth in the future.